focus on the latest fluctuations in the economic data, but Governing Council also spent a good deal of time reviewing our starting situation to ensure that these new developments are put into appropriate context. Is the world economy moderating? Yes. This has been in our forecast for some time. L'économie américaine croît beaucoup plus vite que la production potentielle en raison des mesures de relance budgétaire. Selon nos estimations illustrées dans le graphique 1 du RPM, la croissance économique du secteur privé aux États-Unis ralentit depuis le début de 2018 et elle continuera de ralentir cette année. L'économie chinoise est aussi en transition vers un taux de croissance plus viable et les mesures prises récemment par le pays visent à contrer les effets de son conflit commercial avec les États-Unis. The adverse effects of tariffs on growth are beginning to show up in the world economy as a whole. Our forecast is for global growth of 3.4% in 2019, the same figure we had in October, but this is a material moderation from 3.7% in 2018. Is the Canadian economy moderating? Yes. 2017 was a very strong year with 3% growth, which is well above our potential. Back in October, we were expecting about 2% for 2018 and about the same for 2019. The economy has been operating essentially at full capacity for about 18 months now, and inflation has been running on target. The labor market has been performing very well, not as strong as in 2017, but very solid nonetheless. And unemployment is as low as we've ever seen it. Just last Friday, we received the December employment report with a rise of 9,000 jobs. Not an extraordinary number, but solid. However, notice that there were 17,000 jobs lost in Alberta alone, no doubt due to the recent drop in oil prices. This means that the rest of Canada saw a net rise of 26,000 jobs in December, which is very encouraging. Despite the strong labor market, however, we have seen persistent subpar wage growth. We've offered a couple of new insights on that in today's NPR. Quite simply, adjustment to the 2014 oil price decline continues to hold back wages in oil-producing regions. Elsewhere, the picture is brighter. Just to illustrate, as shown in Chart 8 of the NPR, the Bank's preferred measure of wage growth rose by 1.8% in oil-producing provinces in the third quarter, but in the rest of Canada, that figure was a more robust 2.6%. Cette tendance va probablement continuer, alors que les prix mondiaux du pétrole s'affaiblissent de nouveau. Ces prix sont environ 25% plus bas qu'en octobre. En conséquence, le Canada tire moins de revenus du reste du monde. Évidemment, ce sont les provinces productrices de pétrole surtout qui sont touchées. Mais comme ces revenus servent à acheter des biens produits partout au Canada, les effets finissent par se faire sentir à plus grande échelle. So why are world oil prices falling? Well, the supply of oil has been outpacing demand, and some 2/3 of the increase in global production over the past year has been in the United States. U.S. production and the capacity to deliver to market increased by about 2 million barrels per day during 2018. At the global level, the job of bringing supply back in line with demand is falling to OPEC. So it remains to be seen if oil prices will remain as weak as they have been. Here in Canada, the situation has been made more difficult because Western Canadian oil prices have been depressed even more than global prices. Production has been outpacing our ability to deliver oil to foreign markets. The announcement of mandated production cuts for 2019 caused an immediate correction in domestic prices. This means that even as our prices return to their normal relationship with global prices, Canada earns less because of lower global prices and because of lower production. Based on what we know today, the impact on our economy is estimated to be about 1/4 the size of the 2014 to 16 episode. The price drop is much smaller, the oil-producing sector is smaller, and our oil producers have improved operating efficiency considerably over the past 3 years. The Canadian dollar has declined with oil prices, helping to buffer the effects. Toutes choses égales par ailleurs, les prix plus bas du pétrole entraînent une réduction de PIB d'environ 0,5% à la fin de 2020, selon nos modèles. Par convention, nous utilisons les prix actuels du pétrole dans notre projection. Mais il y a une incertitude considérable au sujet des prix futurs du pétrole et de leurs effets. Governing Council also talked a lot about the Canadian housing market, which is taking longer to stabilize than we expected. This may be because of the various municipal or provincial measures that have been taken, or it may be that the economy is more sensitive to the combined effects of the new mortgage underwriting guidelines and higher interest rates. Home buyers are adapting by seeking smaller, lower-priced homes. Home sellers are offering lower prices. And home builders are adapting to a growing demand for smaller homes. These adjustments are taking time, so we need to monitor the situation carefully. But we must keep in mind that the markets in Toronto and Vancouver were exhibiting a degree of froth. And it is always difficult to judge where the market will stabilize once froth has been removed. Now, taken together, the revisions to our outlook point to a downgrade in growth for 2019 to about 1.7% from 2.1% previously. This results in a modest reduction in our forecast for inflation for 2019, but we expect to be back at 2% by the end of this year. So weighing all of these factors, Governing Council continues to judge that the policy interest rate will need to rise over time into a neutral range to achieve the inflation target. Now, we are fully cognizant of the negative signals being given by financial markets. We believe that equity and bond markets are priced for downside risks, and we acknowledge these risks in our NPR. The trade war is already having negative consequences globally, and these will continue to grow if the situation is not resolved, and especially if it escalates. However, we remain of the view that this risk is two-sided. While this dispute could escalate, it could also be resolved. Therefore, we must take into account both possibilities in managing the risks faced by the Canadian economy. And as today's decision to keep our key policy interest rate unchanged illustrates, we are decidedly data dependent and will adapt our inflation outlook and interest rate profile to developments as they unfold. The appropriate pace of rate increases will depend on how the outlook evolves, with a particular focus on developments in oil markets, the Canadian housing market, and global trade policy. And with that, I'd be happy to take your questions.
Merci beaucoup, Mr. Poloz. So we'll go to questions now. I have a number of people on the list. The first three starting with Kim, then David Lundgren, and then Michelle.
Kim McCrail from the Wall Street Journal. I wanted to ask about the decision to maintain the bank's line in the decision this morning to say that rates will need to rise to a neutral range. Can you help us understand what kinds of discussions went on among Governing Council members about keeping that line in, and also specifically adding the words over time to that line, which wasn't present the last time?
Right. Well, there's no question in our minds that the economy is in a solid footing. Of course, faces risks, and in fact, we're facing some renewed adjustments in the oil sector, which are sufficient to have a macroeconomic effect on our outlook as laid out here. And so we're not dismissing those things, but suggesting that our analysis implies that deviation from full capacity will be temporary, and it's not long enough to have a material effect on the outlook for inflation, which matters to policy, which is 18 months to 2 years from now. So if inflation is on target 2 years from now, then policy is on the right track, is essentially what that implies. And with that in mind, we still believe that the economy is headed to what I've described before as home, which is operating at full capacity in level space with growth approximately the same as capacity growth, and with inflation on target, and with interest rates in a zone where they're no longer stimulating or contracting aggregate demand. That position is what we call a neutral range, and as I've said many times in the past, we call it a range because there's a considerable uncertainty about where it is. It's more like you won't know until you get there whether you're having stimulative or non-stimulative effects on the economy. And the estimates are driven by a range of methodologies, not the usual statistical range that you might be thinking of. Each of those methodologies themselves has a statistical zone of uncertainty around the point estimate. And so it's one of the fuzzier concepts in economics, what is neutral. But we believe that's where we're headed, and we're confident that neutral would not be where the interest rate is still negative in real terms, which is where we are today. So it should be a rate that's higher than today. And the best estimates we have right now is the sort of the 2.5% to 3.5% range. But what we're doing is we're working on that issue now. We'll bring people up to date on that issue in the April NPR when we also update everything on potential. Your last part of your question, Kim, is about over time. I mean, it's if you like, it's meant to inject a degree of ambiguity into the timing of this, because obviously we're dealing with developments over the last few months that constitute a delay. Yeah, you know, that we're less close to home than we were 3 months ago. And so we need to see how the economy reacts to that, those changes of circumstances, and adapt to that as we go along. And so the phrase over time is meant to convey that there's no regularity, there's no preset course. It's all about data, and that it's purposefully vague. So that's why I'm not going to explain how long it means.
Sorry. To follow up on that, when you say you'll have an update in April, do you anticipate updating what the neutral range is estimated to be? And how much fuzziness is there when we talk about 2.5% to 3.5%? Could it go outside of that zone?
Yes. Well, yeah, first of all, yes. What we're doing is that's one of our very basic ingredients of an outlook, and it's just like potential output, which requires a lot more work each time we update it. So that's the plan is always that we would update that once a year, at the same time as we do potential output. That's in the April NPR. And so just as a technical matter, yes, if one methodology says that the neutral rate is, let's say, 2.5%, then there would be a statistical range around that you know, the econometrician would say, well, really, it's somewhere between this and this, with 2.5 in the middle of their estimate. But there's not really there's no real good basis for choosing one methodology over another. All of these things are informative, and that's why I say the most important thing is when we get close to it, I think we're going to know. We're going to be able to see whether or not we're having further stimulative effects. And so, you know, a bit like landing an airplane on a foggy day, you feel the wheels touch, and then you think, we've arrived.
David Lundgren.
Good morning. I'm noting economists' notes again saying that your projections are too optimistic. Is this just noise that you would expect to happen, that not everyone agrees with what you think about where the economy is going, or are you concerned there's some sort of disconnect developing here?
Well, I don't know. I haven't seen any commentary yet, of course, but I would just ask you to look at the numbers. As of yesterday, as far as I knew, the vast majority of commentators were predicting 1.8% growth for 2019, and we've got numbers in front of you which say 1.7. So that doesn't sound very different to me. So how they could describe 1.7 as wildly optimistic is beyond me.
And secondly, you said that the use of the words over time were intended to introduce a certain element of ambiguity.
Right.
But should the markets take that as meaning there's going to be a pause, a definite pause, as opposed to kind of increased uncertainty as to where you might be going?
Well, I don't think I can be any clearer than what we've been in the press release, which is that we still believe that interest rates over time will move higher, and that timing will depend on how the economy evolves. And so I don't want to oversimplify this or overcomplicate it, but we've had experience in the past where the term gradual is code for every second meeting. That's too constraining. That's, in fact, as we said, when we dropped the word gradual, we didn't know at that time whether it would be faster than every second meeting or slower than every second meeting. We wanted to allow for both possibilities, so they would depend on the data. And, well, lo and behold, it obviously is more gradual than every second meeting because it was October when we dropped the word gradual, so it's been 2 meetings. It's all about the data, and over time is just to indicate that it's going to take time for us to get what we need out of the data, confirmation that the story is on track, and therefore that policy can be ready to move us closer to neutral.
Okay, I'm going to Michelle at the back there, to the right.
Monsieur Poloz, en français, en ce qui a trait au ralentissement dans le marché du logement, à quel point est-ce que c'est un facteur, une source d'incertitude importante pour expliquer la stabilité du taux aujourd'hui?
Bien, pour le moment, c'est vraiment juste les ventes des maisons existantes qui sont en doute, parce qu'on voit toujours les déclins dans les ventes et aussi les déclins des prix. Alors, c'est évident que nous n'avons pas trouvé un niveau d'équilibre jusqu'ici, mais on prend de confiance des mises en chantier. Ça continue à un niveau assez élevé. C'est à cause de la croissance de la population en général et aussi le marché du travail est très fort. Alors, nous avons une espèce de plancher en bas et on regarde les constructeurs des maisons, ils ajustent au changement de demande qui sont pour les maisons un peu plus petites. Après avoir planifié un développement de maisons, c'est très difficile de changer immédiatement ces maisons. Ça prend du temps, ça peut prendre du temps jusqu'au printemps, par exemple, pour voir cette évidence. Alors, c'est juste cela. On voit aussi les hypothèques, les données sur les hypothèques, ils ont stabilisé. Alors, ils recommencent à croître. Alors, il y a beaucoup d'éléments de stabilisation présents, mais ce n'est pas plein jusqu'ici.
Quand vous parlez d'une augmentation des taux directeurs avec le temps, donc c'est pas tout de suite, mais ça s'en vient, qu'est-ce que vous voulez dire et pourquoi vous vous laissez une porte ouverte comme celle-là?
Avec le temps, c'est-à-dire c'est une chose assez vague, et c'est vague pour une raison. C'est parce qu'on ne sait pas quels seront les ingrédients qui nous donnent la confiance que l'économie est prête pour les autres hausses de taux d'intérêt. Alors, c'est avec le temps, et avec les données plus fortes dans le secteur des maisons et aussi de l'ajustement de l'économie au prix de pétrole plus bas. Alors, ces choses vont prendre du temps, mais je ne sais pas combien de temps.
Karina.
There is a report out from the Office of the Superintendent of Bankruptcy that insolvency is the highest since 2011 in the fall, and especially in Alberta. And I guess my question would be, what are your concerns about that in terms of people declaring bankruptcy and the factors involved in that?
Yes, well, first of all, we're acutely aware that our decisions affect everybody. They affect financial well-being of everybody, and many Canadians who are carrying a large debt load. And it's not, I don't have to work hard to remind myself of that. I get daily correspondence from people explaining to me what their situation is. So I know it can be difficult, especially if they're overextended. And it's why we've been very careful to be very gradual in this process, and in fact, talked about it extensively well before it began, reminding people that interest rates were at very, very low levels, very unlikely to be sustained. So we've done our best on that front. Now, on bankruptcy statistics, I understand that they have picked up, and that too is understandable. My understanding of the data points is that they're picked up from an extraordinarily low level. And so that there is, you know, at any point in time, always a certain number of unfortunate folks who may lose their job or what have you, and go through this process. And it's wouldn't be surprising to see things pick up a little bit when interest rates have risen. So just to know that we're very sensitive to this. We're analyzing in extreme detail the mortgage renewal cycle. And when I say extreme, we have anonymized microdata for every mortgage from 2013 onwards. And so provided that if you've got a 5-year mortgage and you took it out in 2013, like last year, you renewed it, and we knew you were going to be renewing it. How many people would be renewing, and we know how much is still owing, and we know what rate they renew at compared to the rate that they had before. Therefore, how much their payments are changing. So we have a very rich data on how cash flows are being affected by the interest rate cycle. This contrasts to when I was much younger, doing the forecasting here at the bank, back in the late 80s, early 90s. And all we had was our little model, that showed that when interest rates went up, this is what would happen. Now we can literally do the arithmetic around it. So that's a very helpful insight. So we're watching that very carefully, and we'll continue to do so. And it's why we said all along it would be a very gradual, data-dependent process. And we dropped the word gradual mainly because markets interpreted that as a very regular interest rate hike process. It's as I've said, we illustrate today, it's not that regular. It depends on how the economy is doing.
Obviously, in many of your reports over the past year or two, you talk a lot about uncertainty. And in previous reports, a lot of it's centered around NAFTA. And we have a bit more certainty about that now. But now we've got Brexit, and we have a US-China trade war and all of this. And I wanted to get your sense of how Canada, our little middle power that we are, how we can buffer against this ongoing, continuing uncertainty. If it isn't one thing, it's another.
Yes, unfortunately, there doesn't seem to be a place to hide from uncertainty like that. But what we do is certain types of uncertainty have a higher weight than other types. And so when NAFTA was front and center, I mean that was truly front and center for many companies. It's all they wanted to talk about for quite some time. And we saw in the third quarter data that investment in Canada really almost stopped in that peak period of uncertainty around NAFTA. So knowing that companies, a vast majority of companies in the export sector are operating at capacity or even stretched capacity and wish to invest in order to expand and have been holding back, suggests that removing at least some of that uncertainty with a signing of CUSMA, which is, I guess, anyway, it still doesn't quite roll off the tongue, does it? But anyway, it certainly rolls off the tongue a little bit better than USMCA. But in any case, the new NAFTA, even though it will take several months still, if everything goes well, for all the ratifications to take place, still there's been that's a significant step forward. So our sense in talking to people is that they're much more prepared to invest today than they were before that happened. And on top of that, the government's additional incentive in terms of writing down the cost of capital equipment ought to be an extra incentive for that to happen. And so for those reasons, the investment outlook is, for both of those reasons, the investment outlook is bumped up in this forecast. But we still have not removed all of that uncertainty that we had injected over a year ago into our modeling for that. And so, that would just be imprudent. We want to see it happen before we get convinced that all the uncertainty has gone away. I'm sure it hasn't. Today, the most important bit of uncertainty appears to be, on the U.S.-China trade front. And the issue with that is, that affects such big parties in the world, and that it basically affects the entire world. And so if the world economy is going to slow down, which as I've said, it's moderating, but if it were to slow down more significantly than that, then that's going to affect every country. And so you're seeing this in expectations of the soft surveys. So a lot of companies globally quite concerned about the future of economic growth at this stage, and you see it in the stock markets as they adapt to that.
David Cochran.
Hello, sir. On page 7 of the NPR, you talk about how you just referenced it in your answer to Karina about the federal tax measures targeting investment. Can you quantify the impact you expect those to have and give us a sense of where you think the investment climate, the business investment climate would have been had the government not responded to the U.S. tax changes?
Well, what we had done was we had identified in the previous NPRs for about the past year that there had been a competitiveness wedge had opened up basically based on corporate taxation. And so basically this change that has been put in place in our, it's a different form, but roughly speaking, it provides an offset to that wedge that we had there. I think, and there's still some second decimal points floating around in that analysis concretely, but between you and me, it's basically constitutes an offset. So that competitiveness disadvantage that we had put in, which was slowing down both exports and investment, and they kind of go together because if companies are at capacity, they can't grow their exports as much as demand is going up until they have the ability to expand. And so that wedge has been removed as a result of that. So that's pretty significant stuff. We've been carrying that in there for more than a year. So that's what I mean, that some of the judgment that was holding back the forecast, and appropriately so, because the data proved that out, has been taken out, and so we get a more robust export and investment outlook here, not flying off the charts, but indeed there's upside risk in there because we're being careful not to overdo that.
And when you talk about upside risk and how you're moving towards a more neutral rate over time, as you say, is there a point you see where the fiscal policy of the government needs to move away from sort of the stimulative approach they've been taking in terms of deficit spending to help boost the economy. Do you see a point where fiscal policy might need to change to get more in line with your going with monetary policy?
Well, I won't express an opinion on what fiscal policy should be, but just to comment on how you go about measuring, how you actually pose the question, because it's a more complicated question than you make it sound. So the question is what happens to the measured deficit as the economy approaches full capacity. Normally it would go down by itself because the automatic stabilizers reduce automatically. So revenues pick up, and fewer people on EI, et cetera, kind of those things go down. And so that's why economists often will talk to you about the cyclically adjusted fiscal stance, which I'm afraid I don't know what the cyclically adjusted fiscal stance is. But anyway, but that's why you would think of it that way. So either way, deficits are pretty small, like as a share of the economy, and it's small enough so that the plan shows debt, Canadian government, federal government debt as a share of the economy declining. So that's that's really not much of a macro thing. I would just say that it's important to keep also the history in mind, because we've been saying we've been in around operating close to capacity for pretty well 18 months now. But we would not have gotten there at that same time were it not for some of those fiscal actions that were taken. So it would have meant a longer period of very low interest rates instead. So a different mix of policies, right, in order for us to achieve the inflation target. So that's how your question becomes very complicated. And I would say it doesn't lend itself to a simple answer, and I urge you not to take a simple approach to it. So that if we had the unfortunate mix of even easier monetary policy and no fiscal action when the economy had all that excess capacity, well, we would have had even hotter housing markets and more financial stability risk and all those things. So you can imagine the counterfactual. So it's not meant to be a defense or anything like that, just to explain that the world will look a lot more different than you think, than just if it didn't look like that. So remains to be seen how it all ends up when we get to home.
Okay, I've got Greg next. There are several people on the list still, so Kevin after that, and then Raul.
Good morning. I wanted to ask again about the goal of reaching a neutral interest rate. This is something that hasn't been done in many countries over the last decade, and the idea that the picture of an economy that is facing a current setback and still talking about the need for potentially multiple interest rate increases, how does that square? How do we know that we still need to get to neutral at this point in Canada?
Well, our assessment is that the impact of the decline in oil prices that is at the heart of this update, that is, as you describe it, a setback, a delay, and that the economy, in fact, we basically have in there 2 quarters of softness, around 1% growth in two quarters. It'll be complicated even more by the movement in oil inventories, which build up a lot in the third, fourth quarters. So what happens in our forecast actually is that the quarter we just finished, the fourth quarter, is the forecast to be the weakest quarter overall. That in the first quarter, meaning now, we actually start to get recovery in many of the elements of demand, but it will not show up yet because they'll still be running down those oil inventories, which will subtract from GDP growth in Q1. But the underlying domestic demand indicators are probably going to look quite good over the course of over the next 4 or 5 months, and so that picture will be coming into focus. I'd say as the snow melts, we'll have a clearer view that the economy is back on track, and then likely to grow above or around 2% after that. So that's material, and yet it's not a cancel your trip. It's a detour. And so we believe that as we get through that and as the evidence becomes clearer, the case for, again, contemplating reducing the stimulus that's going into the economy will get stronger again as the confidence grows that narrative's on track. But we have to say it depends on how the data turn out, as usual. We're not going to do a whole scenario for you out in front, but that's our belief is the economy will be back where we thought it was just a few months ago in just a few months, and so then we can talk further about how we get to neutral and where neutral actually is, because otherwise the outlook for inflation for 2 years from now is around 2%. If the economy is growing at above, it gets back to where it's growing above capacity, then we've got to be watching whether there's any room for that growth to happen. If there's sufficient room, then okay. But if not, then that'll augur for inflation drifting above target 2 years outwards. And that's, of course, the trickiest part. And you'll say, well, why would interest rates need to go up if inflation is stable and everything? Well, it's a bit like being in a hockey game, right? If you're Gretzky at least and others, you put the puck out in front of the guy you're passing to, because you got to anticipate where he'll be when the puck gets there. And it's not much good to just aim it at his feet. And so targeting inflation day by day is like aiming at somebody's feet. You got to be, because it takes 18 months for you to have any effect on it. So we've got to be looking ahead, and so if you do it perfectly, it'll always look a little bit silly because inflation doesn't move. Why did you cut rates? Why did you raise rates? Inflation never moved. Well, it didn't move because we cut rates and raised rates, right? So, I mean, if you look at today, when we cut rates back in 2015, inflation's been on target for the past year. Well, that suggests that was the right thing to do back then, but it takes 2 years for you to validate that it was literally true, right? So it's a difficult period in which to explain all that. So, but that's why we take so much time on the forward-looking part, and why the forecast matters a great deal.
Secondly, sir, I was just wondering, when I look at the industries that make up Canada's economy, energy is in trouble. That's a big industry. Manufacturing has had the headlines about the General Motors plant. Your report says that housing has been weaker than expected. What are the industries that are going to drive Canada's economy to full potential or back to normal in the next couple of years, if those factors probably aren't going to be the drivers?
So, so you've just mentioned the oil business and the auto business, which together would take us up to less than 5% of the Canadian economy. They're important. They're 100% of the economy for some people, right? But it's important to understand that there's a whole lot of other things going on out there that are actually doing really well. And so, just in a sector such as IT services, which is growing at 5, 6, or 7% per year, the leading growth job creator, the leading export category, the leading in many respects, is now bigger than the auto sector plus the aerospace sector combined. So, the fact that it's growing at 5%, while other sectors may be either stable or possibly even shrinking in the case of the auto sector, which, being from Oshawa, I regret that very much. When I was young in Oshawa, there were, 10 times as many people working there. 75% of my high school class went to work in General Motors. It was a really important part of the town. And so what has happened over the past 40 years has gone from that to almost zero, and it'll be zero in Oshawa. And yet, Oshawa has grown, and people live there, and they all have jobs. So, this is what happens in economies, and that's the thing you have to admire, that the economy, that Schumpeter's creative destruction thing is true. And so you don't have to look far to see those things. So we look at this, we say, well, by all of our readings, something like 90% of the economy is on operating at capacity, having trouble finding workers, struggling to invest, and to grow and so on. So we have to pay a lot of attention to that. While at the same time acknowledging that the economy will always have the stresses of, some form of something's declining. And so in the oil sector is a great example where, the oil sector grew far in excess of everything else, from about 2008 until 2013, 14. And so it grew to be a much bigger share of the Canadian economy. But what was happening in the rest of the economy? Many places were being crushed by an exchange rate that was at parity or above, and weak international demand for their products. And so somehow the economy got back to full capacity. It's not magic. It's hard work and growth and the development of new companies. And so seeing that and understanding how history evolved like that, it gives you a lot of confidence that Mother Nature really works to make these things happen. And so in the end, I'm confident that we're going to be okay through all this, and that the key for folks, for example, in Oshawa, is to focus on how do we adjust. And that's what I'm reading, is that there's a lot of effort going into helping people identify opportunities. Maybe they require some training to transition, but that training's available. And so I think that makes me feel optimistic that we're going to manage these adjustments reasonably well.
Kevin.
Hi, Governor. A while ago, you identified this phase of the economic cycle as perhaps a unique moment where we're adding capacity, which would increase the economy's ability to grow without sparking inflation. I wondered if you could give us an update on how you think that's unfolded, where we might be in that cycle, and whether you think there's much capacity building to be done if it happened the way you thought it might.
Yeah, I thought when you say a while ago, it was probably at least a year ago. And I did think that 2018 would be more fitting into that narrative than it was. And the fact is that one of the key parts of that process is one where demand is picking up, you reach capacity, and you have a decision point, and you expand, and so you add to Canada's productive capacity. And then there's more room to grow, so you grow the sales, and no inflation happens, right? And so each economic cycle has that period in it. And we've had a modest amount. Like if you were to look at the history of our estimates of potential growth, they got as low as like 1.5%. I may be missing by a decimal point, but 2-3 years ago they got really low. And I can remember when I did the speech in Quebec City that I said, potential of 1.6 or 1.7 every tenth really matters, right? If you could do interprovincial free trade and add 0.2 onto that, wouldn't that be something worth doing? That kind of analysis. So the point is we're up to 1.9 now. And so that has pretty profound implications for the level of Canada's potential. And it's because there's been, lots of bumps and wiggles, but some pretty solid investment along the way. And this is not something we usually assume. We wait till it actually occurs, right? We can't assume it, otherwise we'd always be too rosy. So you build it in when you see it. And then 2018 was an off year because NAFTA uncertainty really slowed down that investment story. So I'm hopeful, right, that as we get into this year, that can resume. Now, a bit of a fly in the ointment of that narrative is we got those big revisions from StatsCan, the historical revisions for the national accounts. And what they show is there was quite a bit less investment in the past than we thought before. It seems to be mostly related to the oil shock in 2015 and 16. And so it could be, I'm entering speculative territory now because we will do a thorough job of this in April. But what it could mean is that there's less capacity in the oil sector, and that's all right because they are in a process essentially of downsizing from that extraordinary level that we saw back in the 2013 or 2012 zone. So it remains to be seen. If you think about the Canada's capacity, if you've got excess capacity, but it's in a pocket where it's never going to be used, sort of an abandoned capital, then of course it doesn't really count as capacity or non-inflationary growth capacity. And so there's those kinds of issues that we'd like to take a look at. All to say that until we establish a stronger growth track in productivity, we won't be assured that the narrative that you're describing is actually taken hold. And that hasn't really occurred yet. So, it does connect to wages too. So if you look at that chart, 8B, this nice chart that decomposes the wage rates between oil-producing provinces and the rest of Canada. So what you see is that wages for the rest of Canada have been pretty steady at just a little less than 3%, for 12 years, except for a bit of a boost during the really strong oil prices period when it spread around the country, and then a bit of a slowdown during the really weak energy prices in 2015, 16. So apart from that, that thing has been very stable. So all the major moves in the total series are because of oil terms of trade shocks, like the one we're going through right now. So that's an important story. If you just watch the rest of Canada line, that will just depend on productivity being coaxed up and giving license to have a little stronger track for wages. And if that's occurring, then we'll know we'll have that magic combination where potential line is going up a little faster and we can have a longer period of growth without inflation pressures. And, it could take longer that's another reason why you could, that would argue taking longer to get to neutral because you've got room to get there. And so for all those reasons, among all the others, we're decidedly data dependent.
My follow-up's a housing-related question. Sort of toward the end of last year, various interests from the real estate industry were looking at some of the data that's reflected in your report today and saying this negative data shows that perhaps macroprudential has gone too far or run its course and that some of those regulations should now be rolled back. Does your assessment, your negative assessment on what's going on in housing support that view that in fact macroprudential regulation may need to be rolled back at this stage?
Well, the macro, when you say macroprudential, I think of just the stress tests and the mortgage or underwriting rules. And those things were important to reassure us that the quality of new debt would be higher going forward, to make the stock of debt more resilient to interest rate fluctuations. And I think that was important to do regardless of what was going on in housing markets. And we were never aimed at somehow trying to control heat in housing markets. If you mean by your question, by the wider set of things like taxes on foreign buyers and those kinds of things, they clearly have done something to take some of the froth out of the markets. And of course, obviously everything happened at once, so arguably the combination is working. Plus, in addition, interest rates have moved. So this is why we say that we need to. Out of those things, the thing we know most about is how interest rates affect the economy. We agree it's probably more sensitive to interest rate movements than in the past because of the stock of debt, And we've got those micro data, and we've got quite a lot of insight into that process. But we don't change the B20 guidelines with regularity to be able to put them into a statistical model. And for sure, we don't do these other changes in the local housing markets to be able to assess how they might. So it's when you have a frothy market and you do something and the froth goes away, then you say, oh, there, now we found the real market underneath the froth, like a beer. If the beer's got, I'm really into them today. So, but a beer with lots of foam on top, you got to kind of work to get down to the actual beer. And so anyway, and to understand whether it's good tasting or cold or what have you. So I think similarly in the market, we had some uncertainties going in, and for sure the question about the quality of debt would remain. I mean, the stock of debt is high. What we've got is assurance now that the debts that have been incurred over the past year have been much higher quality, and therefore the stock itself is improving its quality through time, and people will be more resilient. And so I would argue forcefully against any sort of notion of a rollback in those kinds of tools. Finally, I guess if what I hear often is that the higher interest rates make houses harder to afford. And I mean, that's obviously mechanically true. It costs more for your mortgage. But if they work to help take some of that froth out of markets, I think, the fact that housing prices were rising in double-digit paces was a much more important factor to the affordability issue for people. Being in bidding wars and stuff like this, and a lot of that has gone away. And so that's a healthier marketplace, a more predictable marketplace. And I think that's more important than, a few basis points on the mortgage rate.
Okay, we have gone way over time, so I'm afraid that we are run out of time. So I'm going to call it into this press conference.
All right.
Okay, thank you very much for coming, and thank you, Governor.
Thank you. Bye-bye.